Alright guys, welcome back to another video. This is kind of a remake of my previous video. The recording that I was doing before was terminated for some reason, I guess for a little bug on the software, but I'm going to do this again. I'm going to basically show you exactly some technical chart patterns if you're more of a technical trader versus a fundamental trader. Two types of trading: technical analysis, fundamental. Two types of analysis: fundamental and technical. Technical is basically just identifying chart patterns. Fundamental is basically looking at the numbers, the income sheets, the statements of cash flows, all of that, just for long-term investing. I believe that it's more for long-term investing than rather, I guess, short-term. So, but again, short-term and long-term, it's relative to what you think short-term and long-term is. But yeah, you get the point. So basically our first chart pattern here is a head and shoulders, right? So this occurs at the top of the chart usually, and basically has a shoulder. So as you can see on the left side, it has a shoulder here. So we identify the support level or the neckline of the head and shoulders, and we see a shoulder here form. It comes back down, hits the support level or the neckline, then goes back up and forms a new high, which is going to be the head, and then it comes back down to the support, and then it comes up to form a new shoulder around the same level of the previous shoulder. And then it gets rejected. Doesn't need to be the same exact price, doesn't need to be any of that. It just needs to be around that general area. So if you want, you can draw like a resistance line here, and it'll be a general area of where the shoulder will be. Then it comes back down, test this support level again. It may consolidate a bit and then head back down. And then, sorry, I just ate. And then after the close, so we see this bar here, that little bar that you see going to the right is the closing of that day, the closing price of that day. So it closes below that that support or neckline, and then it continues to go down, and then it comes back up to test this previous support level, and this now becomes resistance, and then it comes back down. So that's basically head and shoulders. This usually tells you when the stock is now going to go on a downtrend. So this is in 7 months, as you can see. So it takes some time to form. It doesn't really form like, but it depends, because we're looking here at a 1 day, 1 minute, sorry, not 1 day, 1 minute, 1 year daily chart. So yeah, within 7 months. So if we go down, now we see a 1 day reversal, and basically this can occur at the top or the bottom. So if we're going up, if we're at a up bullish trend, the 1 day reversal will indicate that downtrend is starting to form. So we see the bearish engulfing candle here, which is basically filled with a lot of, like, the volume, like a lot of sellers are selling, so it's the majority of the candle is filled. It could either be white in this case, because we have black and red, or white and red candles. And in a bullish trend, it'll be black. So I think if we scroll down, all right, no, thought it would show us the bullish 1 day reversal, but it's basically the same thing but below. So if the chart is trending downwards, then we see the 1 day reversal, and then if the next day price is above the previous day close, then it's a good confirmation of a 1 day reversal. So yeah, that's what that is called. That is what that's called. And if we scroll down a little bit, we see an uptrend. And basically, sorry, just making sure we're still recording. So basically, an uptrend is basically when you identify diagonal resistance and diagonal support. So the resistance would be this line up here, and the support would be the line down here. So as you can see, the trend is bouncing up and down, testing support and resistance levels, and we're just waiting until it breaks out of it or continues, to go up. But of course, not everything continues to go up. It comes down at some point. So just keep in mind. A real life example of a uptrend would be PSLR. which is a stock that I previously talked about on my channel, and I pointed out my trading strategy on how I plan to trade this stock. So if we highlight this section here, I identified a line of resistance and a line of support, and my simple moving averages are proving that support level here. So it's going, hitting resistance levels, hitting support levels, hitting resistance levels, hitting support levels, all the way up until it breaks out of this uptrend. But yeah, so as you can see, it broke above the resistance. I don't know if that's changed in uptrend direction yet, because hasn't really. Usually it breaks out like this sometimes, and it comes back down and tests. So we'll see. Only time will tell. Here we're overbought, so makes sense that it'll be above the resistance level that I drew here. Here again we're overbought, so it makes sense that we're above that, or that resistance level. So yeah, that's basically an uptrend that is actually forming as we speak as of today. So if we scroll down a bit, we basically see how support levels are identified. Support levels are identified when there's a lot of rejection in a certain area at a certain price. So let's say this stock goes up, goes back down, bounces off this area, so it goes back up, consolidates, goes up, and then back down around this price area, then it goes up. This right here could be a head and shoulders, this could be the shoulder, this could be the head, this could be the shoulder. And then if you would want to wait till a break in the neckline or the support level, and then for it to confirm the new resistance, you can. But yeah, so that would be support levels. Believe it or not, we go into resistance. And what is resistance? Basically, resistance is when a price always get basically the same thing for support but reversed. I mean, when a price keeps on getting rejected at a certain level or certain price, and then it comes back down to support, and then basically what we see here on VSLR. You could still identify support and resistance lines when a trend is consolidating, which means when the prices are in a horizontal manner. So like basically, I mean, you kind of get the point. But yeah. So yeah, that would be resistance levels and support levels. So methods to establish support and resistance. Same thing I said before, just identify where the prices are getting rejected around which price, and same thing for support. So we see here that the price is not going lower than this level here, so that's it's safe to say that this current support level, and this is safe to say that's the current resistance level. Previous support levels can become resistance when the chart becomes down, like goes below that, and then shows signs of new support, and then confirms that resistance, which was previously support. As you can see, it bounces like this, comes back down, and so on. And this is what I meant by consolidation. It's just trade sideways like this, rather than an upward manner, or rather than a downward manner. Okay, so this right here is a symmetrical triangle in an uptrend and a symmetrical triangle in a downtrend. So in an uptrend, the prices are increasing, hits the top, so this could be resistance, this could be support. It hits resistance, comes back down to support, goes back up to resistance, support, and then breaks above that resistance line, and then it continues to uptrend. So this is basically, you know, a triangle, and that'd be the chart. Same thing here, is just reversed. Prices are decreasing, comes to support, hits resistance, comes to support, hit resistance, and then comes back down to continue its downtrend. So now we have a flat symmetrical triangle, which is similar to the symmetrical triangle that we have here, but we just have a flat resistance level. So this is bullish, so the prices are increasing, hits resistance, comes back down, and we see higher lows rather than higher highs or lower highs. So this would be the resistance. It comes back, bounces off resistance, bounces off support, bounces off resistance. Doesn't necessarily need to bounce only twice or 3 times. It just needs to play out, like it needs to be this pattern here. And then it breaks above it and then continues to uptrend. And of course, this is a live example or real life example basically of a flat symmetrical triangle in an uptrend. So this is bullish. It bounces at a new high, gets rejected, goes back down to support, goes back up. We see a new higher low from the previous low, and then it breaks above. It closes, the price closes. That's what that means right there when that little bar is sticking out. That's the closing price. And the highest point right there is the highest price that it hit on that day. So doesn't necessarily need to close at the highest of the day. So it closed above the resistance line, and then the 10-day moving average confirms support, and it continues to go upward. So if you draw an arrow at the end of this support moving average, it tells you the direction of the pattern. So I think I made a previous video showing you about the 20-day simple moving average, the 50, and the 200-day simple moving average, and how they work. And if you want to look at that, I don't know if it was a video dedicated solely to that, or I just mentioned it in one of the videos and went in depth into it. But you can look at my previous videos to understand it more. So that'd be the flat symmetrical triangle in a uptrend, and then it'd be obviously bullish. And then we have a flat symmetrical triangle, but in a descending or bearish pattern. So in a bearish trend. So the prices are decreasing, comes to support. So that basically instead of this horizontal line being at the top, it's at the bottom. And then so the prices decrease, hit support, go to this diagonal resistance level, and it continues. So we see instead of higher lows, we see lower highs. What I mean by that is this point is higher than this point, or this point is lower than this point when we're reading this stock chart like that in reverse. So that's basically it. So it breaks below the support level and it continues its downtrend. So now we see head and shoulders again. We see the left shoulder, we see the head, and then the right shoulder, and then we identify a neckline. Necklines don't need to be exactly like similar to the shoulders don't need to be exactly hitting at the same price and getting rejected. The shoulders could, be at different levels, but in the general area, that's where you want to identify. Necklines don't need to be completely horizontal. They can have an angle to it, as we can see here, and then it breaks below the neckline and then comes back up to retest that previous support and now becomes resistance and continues downward. Okay, so there is also an inverted head and shoulders. So it's like basically the inverse of this. But this usually occurs at the top of the chart. This usually occurs at the bottom of the chart due to a downtrend. So this right here is a good bullish sign. You want to look for this pattern in downtrending stocks. So we see a left shoulder form here, and a head, and the right shoulder, same thing. Neckline doesn't need to be completely horizontal. It could have an angle to it, and then it breaks above that neckline or a previous resistance, and then comes back down to test that previous resistance, becomes support, and then continues to form a new uptrend. So yeah, that's basically it. Now, if we scroll down a little bit, we see kind of a real life example of a head and shoulders, neckline, left shoulder, right shoulder, head, left shoulder, right shoulder, head, and this is basically before it continued to downtrend. This is basically after it it broke the neckline or support level, and now this becomes resistance. And this general area could be some support, depending on what previous resistance levels were. So this would probably be a good time to buy and sell at 44 when it retests that. But of course, I'm speculating because I need to see where other previous resistance levels were. Falling pennants, they're basically similar to bullish flags, but instead of bullish flags, you'll see later on in this video. But instead of actually, I'm going to skip that. I was going to say something, but you wouldn't understand since I haven't showed you what a bullish flag is. So in an uptrend, prices are increasing, bounces on the resistance, and usually just forms a triangle like this, or like a pennant, and then it breaks above the resistance and then continues upward. In an uptrend, it usually in an uptrend. Okay, so this is a rising pennant. So these are falling pennants. And then in a downtrend, basically prices are decreasing. Same thing, pretty self-explanatory. In an uptrend, prices are increasing, hits resistance levels, support. It doesn't need to bounce like I said before, like 3 times or twice or 4 times. It just needs to form this general pattern. Rising pennants in the downtrend, if it's rising, it would continue to go down. So that's basically falling and rising pennants. Now the bullish flag that I was stating before. So instead of it, meeting at a certain point, like the resistance and the support lines meeting at a certain point, it's just continuing like this, like an uptrend, just like that. And then, so this is a bullish flag in an uptrend. Prices are increasing, hits support, hits resistance, hits support, hits resistance, and then it breaks above that resistance and continues upwards. Bearish flag, prices are decreasing, hits support, goes to resistance, it hits them to identify previous support levels and previous resistance levels, and then it continues downward once it breaks that support level. Okay, so in an uptrend, this would be a symmetrical triangle, similar to the flat symmetrical triangle, but instead it doesn't have a flat support or resistance. It goes down, similar to that pennant that we were talking about earlier. So in an uptrend, again, prices are increasing. It's kind of the same concept, but different patterns. You want to wait for a break above the resistance level in an uptrend, and you want to wait for a break in the support level for a downtrend. If you're selling stock short, if you're going short on a stock or if you're going long on a stock, depends which one will be beneficial for you. So our next one will be a cup and handle. Basically, this is basically the cup here, and then we have the handle. So I guess a pot or a cup, hence cup and handle. Usually, it doesn't need to be this perfect. This is kind of a perfect cup and handle in a way, but it just needs to have this dip here and then come. So this would be resistance. If I were to draw a line here, a horizontal line, that would be resistance. And if I wanted to draw a line here, that would be support, and then it kind of goes up to resistance, then goes back down, and then breaks above that top diagonal resistance level, and then continues upward. This usually happens maybe in the lower sides of the chart, so in downtrends, or it could also happen when the chart is uptrending. It consolidates for a bit, forms a cup and handle, and then continues to uptrend. So it can happen in any time. So this is basically a common gap. Gaps usually get filled. Just remember that, because once there's a gap, expect it to get filled at a later date. It doesn't. Some gaps don't. There's no set time frame where a gap should get filled. It happens randomly in the future. So gaps occur when, let's say, I'll give you an example, and after market hours, maybe there's a lot of selling, or in pre-market there's a lot of selling or buying, and then once the market opens, the price is higher, a lot higher than where the previous high of the candle. So this is the highs. This is the highest price on that day. This is the lowest price of the day. And as you can see, the lowest price of the day is leaving a gap in between the high of the previous candle and the low of the current candle. So basically, gaps usually get filled, and I'll show you an example here in Snapchat. We see a couple gaps. We see a gap here. This gap hasn't gotten filled yet, so we could expect sometime in the future that the price will decrease to about $7, and that's, I'm hoping to purchase it at that price soon, but I would need to see what patterns are showing at the time. Here is a perfect example of a gap getting filled. This would be the gap here, and then Actually, hold, give me 1 second. Let me see here. Okay, so okay, perfect. I need to highlight everything here. Okay, so the gap went up. It didn't really fill all of it here or here. It didn't fill the whole gap. We still have this section here or this section here to fill. Later on, this was our new low, and it filled that gap. As you can see, the line is kind of lower than its high over here. So it filled that gap in that amount. I mean, so it's pretty random. As you can see, this gap hasn't been filled yet, and this gap has, and this is a shorter time frame than what this obviously will get filled at. This gap here hasn't gotten filled completely. It got filled partially, so we could expect this price to continue downwards and fill this gap soon. So that's basically a live example of what a common gap is. It also could happen in downtrend. So if the stock is downtrending and there's a gap and it gaps down, expect the price to go up sometime in the future to fill that gap again. So yeah, just remember, gaps usually get filled. One day reversal, basically what we spoke about. This is the breakaway gap, and then goes up. One day reversal, and then starts. We can expect from there on it's going to fill this gap here. So different types of gap, exhaustion gap. Wow, I don't think I came this far. Oh, perfect. All right. So exhaustion gap. Exhaustion gap is found at the end of a prolonged uptrend, and it is used to suggest that momentum is slowing or that a reversal may occur. So yeah, gaps up, then the price continues to fall. So a double top pattern, basically when there's a, this is basically happens when it's uptrending. There can be a double top and a double bottom. The top is around this level, hits the resistance, goes back down to support, and then goes back up, and this indicates that the price will then go down, so or break below the previous previous support. So be on the lookout. I mean, there's once you start analyzing the stock charts, you'll come to know that you want the first top and the second top be at a certain time frame, or you don't want it to be too close to each other, and you don't want it to be too far from each other. Actually, far. I take that back. You don't want it to be too close to each other. You want it to actually confirm, give it time to actually do the second top. You don't want it to just go, hit the top, a few days later, hit another top. You want it to actually do this, like have a good amount of time in between each top. And then I believe we get into double bottom, which is basically this right here. Bottom one, bottom two, this would be downtrending. And then this would be resistance levels, and then we go break above resistance, continues to trend up. So if you identified the second bottom, I would probably buy there, and then I'll ride it all the way upwards, and then set a stop loss around probably $16 or $16.50. But yeah, so volume spikes. Okay, for volume spikes, usually when there's a lot of volume, volume is basically the amount of trading going on on that current day, or whatever time frame you have on the chart. So this is a daily. So this is explaining the how much volume is happening on that day. So if it's positive volume, there's a lot of buyers pushing the price up. If there's a negative volume, there's a lot of sellers pushing the price down. So yeah, that's basically what volume spikes are. Usually when you see volume spikes, prices can go up depending if they're if it's selling a lot, or if it's people are buying it a lot. Of course, with people buying a lot, the price goes up. So when they're selling a lot, it could be oversold and the price can go up still. So an island reversal, that's basically when similar to a one-day reversal, but there's like two gaps in between the prices or the bars here. So that's basically it. We talked about volume spikes, gaps, symmetrical triangles, flat symmetrical triangles, bullish flags, one-day reversals, cup and handles, gaps, head and shoulders, inverse head and shoulders. All of these patterns you want to study and become familiar with them so that you can identify them when they happen and get more familiar with whether a stock is going to change in direction, uptrend or downtrend in the future, and that'll help you obviously make money and prevent you from losing money in the future. So if you got some value out of this video, please give it a thumbs up. Consider leaving a comment or subscribing. If you leave a comment with a question, I like to get back to it if I have an answer to it. If I don't, I'll do some research and I'll get back to you with that. But yeah, I'll see you guys in the next videos. Thanks for watching.